Wacker Chemie is a global leader in high-performance materials, supplying silicones, polymers, and specialty chemicals that drive innovation across industries worldwide. Today, Jörg Hoffmann, head of investor relations, walks us through the 9-month financial results, covering key achievements, market trends, and Wacker's path forward. Jörg, the floor is yours.
Hello, everybody. My name is Jörg Hoffmann. I'm the head of investor relations at Wacker Chemie. I would like to walk you through our Q3 2025 results today. As always, if you have questions or something remains unclear, I'm here at your disposal. Just give me a call. So let's get started into our presentation. We had a difficult quarter in Q3. The financial conditions were very similar to what we experienced in Q2. There was no significant improvement. All industries, all regions saw weak order entries, and that made for a rather difficult quarter. Nevertheless, we ended the quarter with 112 million euros in EBITDA, slightly ahead of our expectations, although that was mostly in others. The performance of segments was right on census. We worked hard to reduce working capital, and that showed in positive net cash flow, but utilization across the board remained unsatisfactory, largely because of tariff-induced uncertainty. In chemicals, across the board, the strengthening of the euro didn't really help us. So price and volume mix effects held back the performance in chemicals and in polysilicon, while the semiconductor part of the business continues to perform really well. The solar part is in a difficult situation as there is uncertainty about the future of imports into the US and the conditions tied to this. So our customers are rather hesitant to commit. So we've updated, in light of this, our group outlook. You will recall that we had adjusted our outlook for the year on July 18th. We have become a little bit more precise, and we now are expecting the sales at the lower end of the range and EBITDA in the lower half of the range of 500 to 700. Cash flow will be negative as we are adjusting our CapEx to the new conditions. CapEx in the next years will come down significantly. And also what is, I think, the big news this quarter is we've started a very comprehensive cost project across the board in all segments, targeting fixed costs in production, but also in the administrative setup. We're in the process of developing measures here, and as soon as we have something to share, we will share this with you, but I would expect that only to happen in the first quarter of 2026. Let's have a look at the P&L. What you see here is that the gross profit contracted substantially, a function of pricing, mix, but also here of FX. EBIT turned in as negative, as the EBITDA was not sufficient to cover for the depreciation. And the net income is significantly higher, losses significantly higher, because there was something in the tax line. With Germany reducing the corporate tax rate, it also affects the deferred tax assets. So the deferred tax assets got taken up because the tax rate is lower, and that went through the net income line. What you see here on the right-hand side is very interesting. You see the big impact that currency and prices had overall on the quarter in the year-over-year comparison, the waterfall. And that really, we were rather okay on volumes, though low order intake, we'd expected more. What was really hurting us is price and FX. So our balance sheet's still very strong. Our level of debt is a bit higher than we typically like to see it. We have a long-term target of having our net debt at 1x EBITDA, excluding pensions and so forth. So we're a bit higher than that, but then that's a long-term target. So liquidity stays very high at close to 800 million euros. Inventories were 170 million euros lower than last year. This is a result of lower order intake, but also of our efforts to reduce working capital. Our financial liabilities stayed unchanged. Let's go into the segments. Here's something that you will see repeating through all the segments. As I said when we began this, the order intake is really soft and as a reflection of overall uncertainty in the global markets. We saw volumes stayed flat. The mix was weaker, so meaning we sold a little bit more of standard materials to fill up the plants, but they come with a lower price and lower profitability, and that then shows in the sales and the EBITDA numbers. We have updated our forecast here. We now see a low single-digit EBITDA below prior year. Headwinds from foreign exchange continue, and in Q4 we expect a pronounced seasonality. Typically in Q4, the customers go into inventory control mode, just like we do. But you also have the holidays, and there's frequently this is where you time plant reviews and so forth. So there is less to sell, and that will show in the fourth quarter. Polymers also here, FX left its mark, but the profitability went up because we had a turnaround in the second quarter, so we didn't have that cost in the third quarter. Overall, Polymers held up quite well, but again, we had expected more, or we were looking for more. What's holding us back here is a very soft construction market in Europe, which is our main market, and in China. Biosolutions slightly up, but then law of small numbers makes for big percentages. The sales and earnings here are determined by customer project recognition. So when does it enter the balance sheet? When does it become an AR? When did we record the sale? We will probably see something similar happening in the fourth quarter, but they're doing okay. Utilization rates could be higher. In Polysilicon, as I said, we see very strong demand for semiconductors. We are selling significantly higher volumes than last year. Our new etching line for semiconductors is on schedule and is ramping up as expected. But the solar grade demand is very low, and the ASPs there are weak. So we're adjusting our forecast for Polysilicon and now targeting about 100 million euros in EBITDA for the full year. So the segment is cash flow and earnings positive, but well, we could expect. Net debt increased. You see here as a function of our investments and of the dividend that we paid this year. I think we're still, compared to our peers in the chemical industry, we still have a relatively low level of indebtedness. Nevertheless, we have other targets, so we're working on this. You should expect this CapEx number for 26 to come in significantly lower than 400 million. So that will be a source of cash generation. And that takes us to the end of our presentation, but let's not leave this all with FX and orders week and so forth. The K-Fair happened during the third quarter. The K-Fair happens every 3 years. It's one of the world's premier plastic fairs. And here's a couple of things that we presented at the K-Fair. You know, silicones are an incredibly great plastic. They can do all kinds of things. And here are things that we showed off. You'll find more about this stuff on our webpage. Again, this is a great company. We're having a bit of a hard time at this time, but I think we're in good company here. If you have questions on the third quarter and the other stuff that we talked about today, here are my phone numbers, so the phone number of my colleague. We're looking forward to speaking to you. Thank you very much for your interest in Wacker Chemie.
Disclaimer. As described in the legal section on our website, c11a.com, this publication is for informational purposes only. This means it is not intended to provide you with any investment advice. Any opinion or recommendation expressed by the companies is neither given nor supported by us and should not be considered investment advice from our side. Also, remember that any opinion or recommendation expressed is subject to change without further notice. The content is obtained from sources believed to be reliable, but we do not guarantee its accuracy, completeness, or timeliness. C11a.com and its employees disclaim all liability for any loss that may arise in any form from any use of the information in the video, audio, and on our website. We neither express any opinion on the future value of any security or other investment vehicle, nor recommend any investment based on the information provided. Please consider the publications and our website as a platform for companies to present themselves. You need to seek financial advice from an expert regarding the accuracy and appropriateness of the material presented or recommended by the companies in the publication. As we are just considered a publisher, we may hold and trade securities in the presenting company, whether it is a listed or private company. By consuming our content, you agree to these terms and the terms in our legal section on our website.